Good morning. I'm Gary DeWaal, and this is Bridging the Week for December 16th to 20th, and today is December 23rd, 2019. The Commodity Futures Trading Commission again proposed rules addressing cross-border swap transactions. In response, Chairman Heath Tarbert invoked the German philosopher Immanuel Kant to support the CFTC's proposal, while Commissioner Dan Berkovitz relied on the comedic philosopher Jerry Seinfeld to help frame his opposition. Separately, the Securities and Exchange Commission brought and settled an enforcement action against the company that sold digital tokens to raise funds for a blockchain augmentation system. Although no fraud or deception was alleged, the SEC considered the sale an illegal securities offering. This is the last regularly scheduled edition of Bridging the Week for 2019. So I may join the few remaining celebrations of the season and do some hiking out in the Rocky Mountains as soon as possible. Let's get started. The CFTC and the SEC both addressed cross-border swap activity last week. The CFTC issued proposed rules related to cross-border swap activity, while the SEC issued final rules. The CFTC also issued final rules amending certain requirements of derivative clearing organizations related to risk management and reporting, and proposed rules prohibiting post-trade name give-up practices for swaps that are meant to be cleared and are anonymously executed in the first instance on swap execution facilities. Three divisions of the CFTC additionally issued relief to swap dealers and other market participants to assist in an industry transition from swaps that rely on the London Interbank Offered Rate and other interbank offered rates to swaps that reference alternative benchmarks. After plowing through the CFTC's cross-border release late last Friday or early Saturday morning, I'm not sure which, I have a lot to say on this, as well as to provide some historical perspective and color on the chairman's reference to the great German philosopher Immanuel Kant and Commissioner Berkovitz's reference to Jerry Seinfeld. Check it out on the article version of Bridging the Week at www.bridgingtheweek.com. The Blockchain of Things agreed to resolve charges brought by the SEC that its sale of digital assets from December 2017 through December 2018, labeled as a pre-sale and initial coin offering, constituted an illegal offering of securities that were neither registered nor lawfully exempt. To resolve the SEC's allegations, the Blockchain of Things agreed to pay a fine of $250,000, register its digital tokens as securities, offer refunds to all persons who purchased the Blockchain of Things digital tokens during the ICO, and refund relevant amounts to all qualified persons who request payment. According to the SEC, the Blockchain of Things sought to raise funds through its ICO to help further develop a platform, the Katten platform, to interact with the Bitcoin blockchain to enhance its security and ease of use. At the time of its ICO, the Blockchain of Things claimed that its Katten enterprise technology was a, quote, live network in beta with several active corporate clients, end of quote. However, at the time of the ICO, claimed the SEC, quote, there was no ecosystem of third-party applications developed, end of quote, for the platform. The SEC said that the Blockchain of Things contracted with 4 resellers in Asia and the Middle East to sell its digital tokens in their geographic regions. However, it did not preclude dealing with U.S. purchasers. The SEC argued that purchasers of the Blockchain of Things tokens, quote, would have reasonably viewed the ICO as an opportunity to profit if the Blockchain of Things were successful in its entrepreneurial and managerial efforts to develop its business and ecosystem, end of quote. As a result, the ICO constituted the illicit sale of an investment contract contrary to guidance previously issued by the SEC in its July 2017 The Dow 21A order. This is another enforcement action in a growing stream of enforcement actions where the SEC makes it clear that if an enterprise raises funds through a public sale of digital tokens to develop an uncompleted project, it requires registration, the tokens require registration, or an exemption from registration. One didn't exist here, alleged the SEC, and the consequences were predictable. And finally, the SEC proposed revisions to its definition of accredited investor to enable more natural persons and legal entities to participate in sales of certain securities exempt from registration under U.S. securities law. As proposed, natural persons would be able to participate in qualified exempt security offerings if they had requisite certifications, professional knowledge, or experience, while newly eligible legal entities would include any entity owning more than $5 million US in investments. This is an interesting development and adds knowledge to the list of criteria that makes someone a potentially suitable investor for private security transactions, where disclosure is not so robust as it is with a public registered offering. It all makes sense to me not to base sophistication on a wealth determination, but it's not a universally accepted idea. Check out my views on the article version of Bridging the Week at www.bridgingtheweek.com. Well, that's it for this week's edition of Bridging the Week. As always, there's more information in each article and more articles on the article version of Bridging the Week on the website. You know where it is. Check it out. I'm Gary DeWaal. Have a great holiday season and a happy new year. And until the next edition of Bridging the Week in 2020, ciao.